Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at ENVX.
If you find our talks useful, please consider subscribe, like, and comment underneath. And real quick before we jump in, make sure to check out the special 14-day trial link below in the description for StockOracle.
Right, and just as a reminder, StockOracle is an AI-aided stock research platform. It is definitely not financial advice, and it's not a trading signal service or, real-time market data.
Yeah, exactly. It's an affiliate link, so the channel may earn a commission at no extra cost to you. And remember, StockOracle's AI insights and valuation estimates, well, they can be incomplete or wrong, so you always need to verify important facts yourself.
For sure. Always do your own homework. But man, the data we're looking at today for ENVX ticker ENVX is just wild.
It really is. I mean, imagine you're building this revolutionary product, right?
Yeah.
And your factory floor is hitting like a 90% manufacturing yield.
Which is almost unheard of for new hardware.
Exactly. And your top-line sales just jumped nearly 50% year over year. You've even managed to keep your gross margins solidly positive for 6 straight quarters.
Sounds like a total home run of a business on paper.
Right. But then you look a little further down the balance sheet, and you realize your net profit margin is a staggering negative 500%.
Yeah, it is brutal. It's one of the most fascinating paradoxes in the tech world today, honestly.
It really is. And that's exactly what we are getting into today with the ENVX data. We want to figure out if their battery technology is genuinely a multi-year game changer, or, if a shrinking competitive moat and this massive cash burn make it a high-risk trap.
The stakes are just existential right now. I mean, the market is violently divided on whether they're going to become the new standard for consumer electronics or just another cautionary tale.
A startup that just couldn't survive the transition from the lab to the assembly line, basically. Right. Okay, so let's unpack this from the very beginning. Because before we can talk about their financial bloodbath, we really need to understand what they're actually making. So, ENVX is focused on a silicon anode battery architecture.
Right.
Help us understand why that matters. Like, what is the fundamental difference between this and the lithium-ion battery sitting in my smartphone right now?
Well, the batteries we all use today, they rely on an anode made of graphite. It's stable, it's reliable, and we know exactly how to manufacture it at a massive scale.
Okay, so it works.
It works well, but graphite has a hard limit on how much energy it can actually store. Silicon, on the other hand, is basically the holy grail for battery chemists because it can theoretically hold significantly more lithium ions.
Oh, wow. So why aren't we all just using silicon batteries right now?
Well, that's the catch. When silicon absorbs those lithium ions during a charge cycle, it swells up immensely. It expands, it cracks, and it basically pulverizes itself from the inside out.
That sounds dangerous, or at least really physically unstable.
Yeah, highly unstable. But ENVX's entire value proposition is that they have engineered this unique 3D cell architecture, including a stainless steel constraint system that physically forces the silicon to behave.
So they trap it, basically.
Exactly. And they claim this yields a battery with significantly higher energy density than conventional cells. They want to pack way more power into a much smaller footprint.
And looking at the fundamental numbers, there is definitely a market for that. I mean, Q1 2026 revenue came in at $7.6 million.
Right.
That's a 49% year-over-year increase, mostly driven by the defense and industrial sectors. They actually beat the high end of their own revenue guidance.
Yeah, the top-line growth is absolutely there. The early adopters in specialized fields, they're buying the product.
Plus, the unit economics are improving. Their GAAP gross margin was 20.4% in Q1. A year prior, it was just 5.1%.
That is a massive leap.
It is. They have achieved their 6th consecutive quarter of positive gross profit. So they are officially selling these batteries for more than the direct cost of the raw materials and the factory labor required to assemble them.
Right. The machines are working. The data notes their manufacturing yields are hitting 80% in their Zone 1 dicing operations, which is this highly complex laser cutting. And they're nearing or even exceeding 90% yields in other zones.
Which, like you said earlier, is a monumental engineering achievement, right?
Getting a novel battery chemistry to yield at 90% in a factory setting is just incredibly difficult.
But here's where I get really confused. If the factory is humming along at an 80 to 90% yield, and they're making a 20% gross profit on every single battery they ship, how on earth is their trailing net margin sitting at negative 499.64%?
It's a huge disconnect.
Right. Their trailing earnings per share is negative 81 cents. They have racked up an accumulated deficit of over $1.02 billion. It feels like they built this revolutionary sports car engine, but every time they sell one, they still bleed money? Why is the overhead still killing them if the actual product works so well?
Because you are witnessing a textbook example of the valley of death in deep tech hardware.
The Valley of Death. Okay, explain that mechanism for us. What actually happens there?
So it's this treacherous gap between proving your technology works and achieving the manufacturing volume required to actually sustain a corporation. You see, gross margin only accounts for the direct cost of making the battery.
Okay, so just materials and assembly.
Right. It doesn't account for the staggering fixed costs of running a semiconductor-grade manufacturing business.
Yeah.
Think about the massive clean rooms that require, huge amounts of electricity to filter the air 24/7.
Right, right.
Think about the custom-built proprietary manufacturing equipment that costs tens of millions of dollars just to install. Then add in the global sales teams, the executive compensation, and the massive R&D labs needed to keep developing the next generation.
Wow. So the fixed costs are essentially a giant boulder, and their current revenue stream is just a tiny trickle of water trying to push it.
Precisely. That's why the analyst estimates show their EBITDA margins are expected to stay deeply negative for several years.
Wait, just define EBITDA for us really quickly in this context.
Sure. It stands for earnings before interest, taxes, depreciation, and amortization. In Enovix's case, the depreciation part is huge. They have to account for the depreciation of all that wildly expensive factory equipment over time.
Got it.
Analysts are forecasting a full-year EPS of negative 61 cents for 2026. You are essentially paying for the massive factory capacity of tomorrow using only the meager niche revenues of today.
And that massive fixed cost problem directly explains why their bank account is draining so fast. Because even though they are sitting on a decent cash cushion right now, the balance sheet shows $582.7 million in cash and investments as of April 2026.
Which is a solid runway.
It is, but the burn rate is accelerating at an alarming pace. Their net cash used in operating activities in Q1 was $33.1 million. That is nearly double the outflow they had in the exact same quarter last year.
Yeah, and if you look at their free cash flow, which actually factors in their capital expenditures, it was a $36.3 million outflow for just that one quarter.
And that capital expenditure is only going to get worse, right? StockOracle data flags that they have looming deferred equipment invoices for their Fab 2 facility. Plus, they're trying to fund a massive new capacity expansion in South Korea.
They're spending money faster than ever to scale up.
Which brings me to a financial maneuver that just absolutely baffles me. In the middle of all this cash burn, the company recently authorized a $75 million stock buyback program.
It's definitely the kind of detail that forces you to do a double take.
I really have to push back on the logic here.
Yeah.
If you are burning cash twice as fast as last year to build the very factories you desperately need to survive the Valley of Death, why on earth are you using $75 million to buy back your own stock?
I know, it sounds crazy.
It's like you're building a house, you're halfway through, you realize you're running out of budget to finish the roof, and you decide to spend your last loan installment buying a fancy painting for the living room to make the house look more valuable. It just feels fundamentally disconnected from reality.
I totally understand the skepticism, and it is a very common critique. The counter-argument from management usually revolves around signaling.
Signaling to the market.
Exactly. When a company authorizes a buyback, they're trying to broadcast a message. We believe our technology is so de-risked, and our stock is currently so undervalued, that buying our own shares is actually the best possible return on our capital right now.
But is that actually responsible when you know you aren't going to be profitable this year, or even likely next year?
That is exactly the debate. If everything goes perfectly, if the South Korea factory ramps up without a hitch and yields remain high, then buying undervalued stock looks like a genius move.
Right, but hardware scaling rarely goes perfectly.
Exactly. If they hit a delay or an equipment snag, they're going to desperately wish they had that $75 million buffer back. It is a highly aggressive capital allocation strategy for a company still fully entrenched in the Valley of Death.
And they really can't afford any missteps. Because if we pivot to the competitive landscape, it's pretty clear their rivals aren't just sitting still while Enovix builds these factories.
Not at all.
Investors will only tolerate this kind of cash burn if they believe Enovix has an insurmountable multi-year technological moat. But that moat is being heavily questioned by Wall Street right now.
Yeah, the analyst community is really fractured on Innovex, which is driving a lot of the stock's wild volatility. Bank of America is holding the bullish line. They argue that Innovex still maintains a solid 2-year technological lead over its competitors in the silicon anode space.
And a 2-year lead in deep tech is basically an eternity.
It is. But then you look at JP Morgan, who recently downgraded the stock to underweight.
And for anyone who doesn't read financial jargon all day, an underweight rating is essentially an analyst's polite way of saying, well, sell, or at least reduce your holdings.
Right, because they expect the stock to underperform the broader market. JP Morgan's core argument is that the massive incumbent battery makers are closing the technological gap much faster than people realize.
This is a crucial dynamic to understand.
Yeah.
It's not just a contest of who has the absolute highest energy density in a vacuum, right?
No, it's a contest of scale, cost structure, and distribution.
It's like Enovix has invented a fundamentally faster sports car, but the incumbent battery giants already own the highways, the gas stations, the shipping routes, and the dealerships.
That is a perfect analogy.
Eventually, massive infrastructure and distribution advantages can just beat pure speed.
They absolutely can. The incumbents already have the massive automated factories. They have established supply chains for raw materials. Most importantly, they already have long-standing relationships with the original equipment manufacturers, the OEMs, the device makers. JP Morgan is warning that even if Enovix secures a niche in wearables or defense drones, those markets simply don't generate the massive volume needed to offset their massive factory overhead.
And the market sentiment is definitely reflecting that fear.
Yeah.
I mean, the net news sentiment is heavily skewed negative right now. TD Cowen just lowered its price target to $5.50.
Ouch.
If you look at the technical chart, it is a bloodbath.
Yeah.
The stock is trading at $4.73. That is down 66.7% from its 52-week high.
It's locked in a sustained downtrend,
Lower highs, lower lows. Plus, the stock has a beta of 2.52.
which basically means it is highly sensitive to macro movements. If the broader market goes down 1%, Enovix statistically tends to drop 2.5%. It amplifies volatility.
Yet despite crashing nearly 67%, its valuation still looks incredibly steep. The price-to-sales ratio, the PS multiple, is sitting at 29.49x.
That is steep.
Just to break that down for you, investors are currently willing to pay roughly $29 for every single dollar of sales this company generates today. That is an astronomical premium for a business with a negative 499% net margin.
A multiple like that means the market is entirely focused on the future. Investors aren't paying 29 times revenue for today's drone batteries. They are paying for the belief that Enovix is on the verge of unlocking a massive multi-billion-dollar market.
But the danger of a 29x multiple is that it leaves absolutely zero room for error.
Zero.
If growth decelerates even slightly, or a major timeline slips, that multiple can violently contract. Now, I did see some chatter online about a recent 12.5% bounce in the stock over a 5-day period, coupled with some net insider buying.
Oh, right.
Yeah, I think executives bought around 34,000 shares over a 90-day window. Some retail investors were speculating this could be the start of a short squeeze.
You really have to be incredibly careful with short squeeze narratives.
Let's define the mechanism first. A short squeeze happens when a lot of investors bet against a stock by borrowing shares and selling them, hoping to buy them back later at a lower price.
Right.
But if the stock price unexpectedly goes up, those short sellers start bleeding money and are forced to buy the stock back quickly to cover their positions, which just drives the price even higher in this rapid feedback loop.
Exactly. It's a rapid forced buying frenzy. But the data shows a true squeeze is highly unlikely here.
Why is that?
Well, a genuine short squeeze requires massive, sustained trading volume to actually trap the short sellers. The data explicitly notes that the volume during that 12.5% bounce was actually quite low, only 0.86x the average daily volume.
It wasn't a stampede, it was just a light jog.
Right. And as for the insider buying, 34,000 shares is a relatively modest amount for a company of this size. It's much more likely to be, routine, scheduled buying related to executive compensation or tax planning, rather than some massive table-pounding buy signal for management.
Which brings us to the ultimate question. If the $130 million pipeline for drones and defense out of South Korea isn't enough to justify this 29x valuation, what is?
They need the big fish. They need to get inside smartphones.
And that leads us to the single most consequential catalyst for Enovix's entire future: the smartphone qualification timeline with their lead OEM customer, Honor.
Honor is a huge smartphone maker. Enovix and Honor have been working on a specific qualification framework for these silicon batteries. If Enovix passes these tests, it theoretically unlocks high-volume commercial smartphone shipments slated for 2027.
This is the recovery scenario the analysts are always talking about.
Exactly. This is the life raft that fixes the financials.
It is a binary event. If they complete this qualification, it validates the technology at commercial smartphone scale. It basically de-risks the entire corporate story.
Yep. That $130 million drone pipeline suddenly just becomes a nice diversified foundation, while the smartphone business provides the massive scale needed to finally absorb those fixed factory costs.
And turn that negative 500% margin positive. But there is a massive catch here, and I think this is where things get truly unnerving. Enovix management explicitly admits in their filings that the ultimate timing on such qualification is outside of their control.
Oh, yeah. That's a huge red flag for timeline modeling.
Right. They say there can be no assurance as to when qualification will be completed. They're also apparently in talks for a second smartphone OEM, which is great for diversification. But again, the testing timelines are entirely dictated by the smartphone makers, not Enovix.
This is the agonizing reality of being a deep tech component supplier. You can have the most advanced factory and the brightest engineers, but your destiny is ultimately held hostage by the sprawling testing bureaucracy of a massive corporate giant.
It's just a wild realization. If the biggest, most crucial catalyst to justify a billion-dollar valuation is entirely out of the CEO's hands and depends on an external company's internal testing schedule, aren't investors just gambling on a black box process?
Essentially, yes. The startup has basically lost agency over its own survival timeline. And you've hit on the exact reason why the investment rating for Enovix right now is a cautious neutral. Analysts are simply acknowledging that you cannot accurately model a timeline you don't control.
So what are the triggers we should actually watch for?
Well, the upside trigger is a formal announcement from Honor that the battery is officially qualified, along with the firm production timeline.
And the downside trigger.
Any further delay that pushes those commercial shipments deep into late 2027. Especially if Enovix's cash burn climbs over $40 million a quarter while they just sit around and wait.
The technical data also mentions that an early signal of a turnaround, like a sign that institutional money actually believes the qualification is imminent, would be the stock reclaiming the $5.50 level on heavy trading volume.
Right. Until you see that heavy volume in that price action, you are effectively in a holding pattern, just hoping the OEM bureaucracy moves quickly.
So to bring all these complex threads together for you, Enovix is locked in an incredibly high-stakes battle between the promise of their innovation and the crushing gravity of manufacturing economics.
It's a tug-of-war.
On one side, you have a company achieving a 49% revenue jump, positive gross margins, highly impressive 90% factory yields, and a solid $582 million cash cushion. They are genuinely putting better batteries into drones and defense equipment today.
But on the other side of the ledger, you have that devastating negative 499% net margin caused by the staggering fixed costs of the Valley of Death.
You have operating cash burn that is nearly doubling looming multi-million-dollar factory bills and that deeply debated $75 million stock buyback program.
And hovering over all of this is the warning that incumbent battery giants are rapidly closing the technological gap.
It all comes down to the agonizing wait for a smartphone contract they simply don't control. If the device makers sign off, Enovix could completely redefine consumer electronics long-term. If they delay, that $582 million runway is going to get eaten up incredibly fast by a 29x sales multiple that has a long, long way to fall.
It is the ultimate test of nerve for anyone tracking the stock. You are waiting for external validation to justify a very aggressive internal valuation.
It really leaves you with a profound question about how innovation actually happens. In the relentless race to build next-generation hardware, does the fundamentally best technology actually win out in the end? Or is history ultimately dictated simply by the incumbents, the ones who already have the established factories, the distribution highways, and the deep pockets necessary to survive that long, cold valley of death?
It's definitely something to think about the next time you plug in your phone.
Absolutely. Well, that wraps up our look at Enovix. If you found our talk useful, please consider subscribe, like, and comment underneath. And don't forget to check out that 14-day trial link in the description for StockOracle to run your own numbers.
Thanks for listening, everyone. See you next time.